Hi, I'm Jennifer LeBeau, a realtor here on Philadelphia's Main Line, and this is the first in a step-by-step video series called Home Buying 101. This video is, what do I qualify for? So you've decided you want to buy a house. That's terrific. Guess the first thing you're going to do is go to some open houses, maybe start working with real estate agents to see some things, right? Wrong. Well, it's not that it's wrong. It's just not the first step. The first step, and the title of this video is, what do I qualify for? Because you don't want to be looking at houses that you discover later are outside of your price range. So, to do that, you need to talk to a few lenders. Why a few? Think about when you buy a car. If you're talking to a car salesman and he knows that you're going to go from his dealership to another dealership and look somewhere else, you're more likely to get a competitive price. Similarly, while both dealers may have a lot of the same vehicles to offer you, there are going to be a few that one has that the other doesn't, and vice versa. The first thing a lender is going to talk to you about is your debt-to-income ratio. They're going to want to know what your monthly gross income is, and then they're going to ask you about your recurring monthly debts. Those are things that are set numbers that you have to pay every month. Things like student loan payments, car payments, divorce and or child support payments. That's what recurring debt is. And while there's not a set number, most lenders don't want to see your total debt to income ratio on a monthly basis exceed 43%. So the debt I just talked about was your already existing debt. When you talk to a lender about a mortgage, it's the difference between your monthly debt allowance of 43% for what you already have to pay and what's left over that they can use for your housing obligation. So your housing obligation part of that 43%, some of which is already potentially used up with loans and payments that we talked about, includes your principal and your interest on this loan you're going to be getting, but it also includes the monthly portion of your real estate taxes for the year on the property and your monthly portion of the yearly homeowner's insurance, which all lenders will require you to carry. So once the lender has figured out what your debt to income ratio is, you'll then start to talk about the different sorts of loans that are available. He'll ask about your down payment, how much money you have to put towards the down payment on your house, and the rest of it will be mortgage money. And then he'll start to talk to you about the various loans. There are lots of different ones out there. I'm only going to cover the basics here. The most common loan that I see in my practice is a 30-year fixed conventional loan. So let's pick that apart a little bit. 30 years, 360 months of loan payments. There are shorter term loans, 20-year loans, 10-year loans. Talk to your lender to find out whether you'd be a good candidate for one of those. The next piece I mentioned was fixed. That has to do with the interest rate. A fixed rate loan, which is what most people choose, is what it sounds like. It's fixed and it doesn't change over the course of those 30 years or 20 years, depending on what kind of loan you have. There are adjustable rate mortgages. That's different from fixed. The thing with an adjustable rate is while it often begins at an attractive number, sometimes a little bit less than the fixed rate that you would get, it only stays fixed for a certain number of years, for example, 5 years. After that, it becomes adjustable and it moves as market conditions change. Some people are okay with that, but many are too risk averse because we have no idea what rates will go up to or where they could move. So adjustable rate mortgages are good choices for certain people. Again, you'll talk to the lenders about whether you're a good candidate for one. Finally, I talked about 30-year fixed conventional loans. That word conventional refers to loans that are not government-backed. These are what you may have heard of as Freddie Mac and Fannie Mae mortgages. If you don't understand exactly what that means for the purposes of this video, it doesn't really matter. I only mention it as a way to differentiate those kinds of loans from the government-insured loans, which include the FHA loans and the VA loans. FHA loan is Federal Housing Authority loan. This, like the VA loan, is designed for people who don't have a lot of money to put down for the down payment. They also both have rate caps for the maximum purchase price of a house you can use them for. So you can't use an FHA loan or a VA loan for $1 million home purchase. FHA loans are nice in that you're only required to put 3.5% down as a down payment. The negative on an FHA loan is that you have something called mortgage insurance. It's an extra fee that you're charged every month for the life of that loan, and it never goes away. To return for a minute to conventional mortgages, which I talked about first, if you put less than 20% down on a loan on a conventional mortgage, you are also going to have mortgage insurance. The difference is once you've paid off enough of the principal on your loan to have 20% more or more equity in your home, that mortgage insurance disappears. It's not there for the life of the loan like it is on an FHA loan. VA loans are really wonderful for military vets. The interest rate is often actually less than what you could get on a conventional mortgage. And the great thing about VA loans is that there's no mortgage insurance. You can often also put down 0% depending on the circumstances. So if you're a veteran and you're not looking in a particularly high price point for your area, it's probably a good idea to ask your lender about a VA loan. So that's just a brief overview of the most common kind of loans that we see in real estate mortgages. So after you've talked about your debt to income ratio and the different types of loans and down payments that you might use, the next thing a lender is going to want to determine is your credit score. He needs to do that in order to come up with an interest rate for your loan. Credit scores are a little bit tricky in that logically, yet erroneously, you might think that if you've paid every bill on time, you should have a perfect 800 credit score. And you might, but often that's not the case. 740 is the current magic number in the mortgage industry. And what I mean by that is that if you have a credit score of less than 740, you are very unlikely to get the best rate available that day. So what can negatively affect your credit other than obviously not paying things on time? Things you might not expect, like opening a credit card, closing a credit card. Again, even if you've paid all those bills on time, let's say you have a card and you just don't use it anymore. Sometimes closing it can actually hurt you. Checking your credit score frequently can hurt your credit. So make sure your lender knows that you are going to be talking to several different lenders and to make sure to do what's called a soft pull. You don't need to understand what it is. They will, just so that they realize you want to make sure that in pulling your credit, they don't actually hurt it. Once the lender has looked at all of those things, the debt to income ratio, the type of loan that's best for you, the amount that you're going to be using for a down payment, and your credit score, he can finally come up with an interest rate. And once he's done that, he can furnish you with a pre-qualification letter, which is what this video is about, is what do I qualify for? That letter needs to include a minimum of 3 pieces of information. Has to give the percent for the loan, so for example, an 80% loan that the bank's willing to give you, the maximum purchase price of the property that that loan will be good for, so for example, a $500,000 home purchase price, and it needs to include that interest rate, for example, 3.875%. Once you have that pre-qualification letter, you can go out and start looking at houses. I hope this has been moderately clear and informative. I welcome questions and comments. Please contact me via my website, jenniferlebeau.com. That's JENNIFERLEB like boy, OW.com. And I hope you will watch the other installments of the Home Buying 101 step-by-step video series. Thanks for listening.